Okay, nobody likes hidden costs. What are the other fees, the transaction costs that you need to factor into your budget beyond just the sticker price?
Right. There are several key costs. The big one now is the stamp duty on the Memorandum of Transfer, or MOT. As of January 2024, for foreigners, this is now a flat 4% of the property's value. That's a recent change.
Okay, 4%. What else?
Legal fees for handling the transaction, typically somewhere between 0.5% and 1.25% of the price. If you take out a mortgage, there's stamp duty on the loan agreement, which is 0.5% of the loan amount. And then some states charge a state authority consent fee or levy when a foreigner buys. For example, Johor charges 2% of the purchase price and Penang charges 3%.
So these add up.
They do. Let's take a quick example. Say you buy a property for RM 1.5 million in Johor. You'd be looking at roughly RM 60,000 for the main stamp duty, maybe RM 15,000 in legal fees, another RM 30,000 for the Johor state levy, plus stamp duty on the loan if you finance it. So your total upfront costs could easily be around RM 115,000 or more. That's about 7.7% of the purchase price in this example. You need to budget for that.
Location, location, location. It always comes down to this, doesn't it? If you're looking to invest in Malaysia, where should you actually be focusing your search? What are the prime areas?
We can really break it down into three main hubs, each with its own character and drivers. First, obviously, Kuala Lumpur, KL. It's the economic engine, the main expat center. It's the most dynamic market generally. Forecasts for 2025 show that 3.7% price growth potential and rental yields are strong, averaging around 6.2%.
And within KL itself, where are the hot spots for foreign buyers?
You've got the very prime areas like KLCC, Kuala Lumpur City Center. That's where you find the premium high-end condos. Prices there can range from RM 1,000 to 2,000 per square foot. Median price may be around RM 1.4 million. Then you have the established, very popular expat areas like Mont Kiara and Bangsar, known for international schools, family-friendly vibe, lots of amenities. Second hub, Penang, the island. It's got this great blend of lifestyle, culture, heritage, but also a strong modern economy, especially in electronics manufacturing. We're seeing some cautious growth there, new luxury developments launching. And the upcoming Penang LRT Mutiara line is a big infrastructure project expected to boost connectivity and values.
Areas to watch in Penang.
Georgetown itself, especially for the unique heritage shop houses. Then the coastal strip, places like Tanjung Bunga, Batu Ferringhi, popular for sea view condos, particularly with retirees, and the Timur Laut district generally. And the third key area, which is getting a lot of attention, is Iskandar Puteri in Johor, right next to Singapore. It's really evolving beyond just being a lower-cost alternative to Singapore. There are major catalysts driving growth.
Like what?
The big one is the Johor Bahru Singapore Rapid Transit System, the RTS link. That's due to open in 2026 and will be a game changer, connecting Iskandar directly to Singapore's MRT system. Plus, you have the Johor Singapore Special Economic Zone, JSSEZ, taking shape, and the Special Financial Zone, SFZ, planned for Forest City. These are creating real structural demand for housing and commercial space.
So real growth potential there.
Definitely. Appreciation potential is often cited in the 5-7% range with similar rental yields. Key investment spots within Iskandar Puteri include places like Medini, Eco-Botanic, Puteri Harbor. They have great access to Yadu City, healthcare hubs too.
Okay, let's zoom out again. How does Malaysia really compare when you stack it up against other global hotspots for property investment? Is it genuinely different?
The differences become really stark when you compare directly. Let's take Malaysia versus Singapore. The headline is Singapore's additional buyer stamp duty, the ABSD, for foreigners. It's a staggering 60%. 60%.
Wow, compared to Malaysia's.
Malaysia's flat 4% stamp duty for foreigners, and then look at prices per square foot. KL might average, say, RM 8,500 PSF in prime areas. Singapore, you're looking at maybe SGD 25,000 PSF, which is vastly more expensive. So Malaysia is just far more accessible financially. Okay, Malaysia versus Thailand, we touched on this, but it bears repeating. The freehold advantage. Malaysia gives you that clear perpetual ownership. Thailand legally blocks foreigners from owning land, pushing them towards those 30-year leases or the 49% condo quota, which has less security. Malaysia wins on investment security and control, hands down. What about, say, Dubai? Both offer freehold zones and have property-linked visas. Dubai has its golden visa linked to AED 2 million property purchase. Dubai boasts a tax-free environment, though there is a 4% transfer fee. Malaysia's MN2H offers maybe more structured accessibility across different investment levels. And Malaysia's property market is often seen as more mature, perhaps less volatile than Dubai's can be sometimes. The lifestyle offering is also quite different, of course. But here's the really critical comparison right now, especially thinking about residency. Malaysia versus Portugal. Portugal completely scrapped real estate as a qualifying investment for its golden visa back in October 2023. Gone.
Right, that was big news.
Huge news. And what has Malaysia done? It's effectively gone the opposite way by mandating property purchase for its main MM2H program. This creates this major strategic opening. Malaysia is now arguably the standout global option for people specifically looking for that direct link between buying property and securing long-term residency. It's filled a gap that Portugal left wide open.
Makes sense. But no investment is risk-free. Let's be realistic. What are the potential downsides or risks you really need to have on your radar when investing in Malaysia? And crucially, how can you manage them?
Okay, first, market dynamics. We mentioned the property overhang that's oversupply in certain segments, which could mean slower capital appreciation in the short term. And yes, currency volatility, the ringgit does fluctuate against major currencies. So mitigation. Well, the overhang, as we said, can be a buyer's advantage on price, and the strong rental demand provides that immediate cash flow buffer. For currency risk, the best mitigation is often that local MYR financing we discussed. Use MYR rent to pay your MYR mortgage. It hedges a large part of your exposure. Second area, legal and regulatory stuff. The risk is accidentally trying to buy something you can't, like Malay reserve land, or maybe getting involved with an unreliable developer, or finding title issues later.
That sounds like a nightmare.
It can be, which is why the mitigation is non-negotiable. Use a qualified independent local lawyer and a licensed agent, period. They do the due diligence, the title searches, the verification. Also, sticking with reputable, publicly listed developers generally reduces risk. Third, taxation. Foreign investors need to be aware of RPGT, real property gains tax. If you sell within the first 5 years, the tax on your profit is 30%. After 5 years, it drops to 10%.
Okay, so it encourages holding long-term.
Precisely. And rental income is taxable too. It's generally 30% for non-residents, but that's on the net rental income.
Net income, meaning after deductions.
Yes, you can deduct allowable expenses like mortgage interest, property taxes, repairs, maintenance. That reduces the taxable amount significantly. Plus, Malaysia has double taxation agreements, DTAs, with over 70 countries, which can prevent you from being taxed twice on the same income. But definitely get professional tax advice tailored to your situation.
Okay, let's look crystal ball gazing a bit. What's coming down the track for Malaysia? What developments over the next, say, 5 to 10 years could really impact an investment made now?
Infrastructure is huge. These aren't just small projects. They're transformative. You've got the MRT3 Circle Line expanding connectivity within the Klang Valley around KL. The JB Singapore RTS link, operational by 2026, is genuinely a game changer for integrating Iskandar with Singapore. Then there's the East Coast Rail Link, ECRL, connecting the East and West coasts, and the Penang LRT improving transit on the island. The strategic play is often to invest in areas set to benefit from these before they're completed to capture that uplift. Alongside infrastructure, you have continued government support. Budget 2025, for example, has measures for affordable housing, tax relief, ongoing infrastructure funding. It shows commitment. Combine that with those positive economic forecasts, that 4.5% growth projected for 2025, and the backdrop looks pretty favorable. Quantitatively, the projections for the residential market show a CAGR of somewhere between 5.9% and 6.64%, running from 2025 out to maybe 2030 or 2033. That growth is underpinned by strong demographics, a relatively young population, ongoing urbanization, that expanding middle class we mentioned, and watch out for key trends like sustainability. The Green Building Index is becoming more important, plus the impact of property technology, PropTech, and the rise of these large, integrated, mixed-use townships.
Okay, so bringing it all together, what does this mean for you, the listener, considering your options? We've gone through a lot, from the security of freehold land, the tax details, that RM2H property link, those massive rail projects.
I think Malaysia offers this really quite unique combination right now. You get the security of freehold ownership, which is rare in the region. You get a clear, structured pathway to residency directly linked to property, especially potent now, given the changes in places like Portugal. You get exceptional value for money compared to many other global hubs. And fundamentally, you're looking at a market with solid fundamentals that seems poised for stable, long-term growth, rather than maybe wild speculation. It really positions Malaysia as a premier strategic choice if you're looking for that blend of financial return, asset security, and an enhanced quality of life.
So here's something to think about. If you are considering a global investment, one that truly weaves together owning a tangible asset with a vision for your long-term lifestyle, what new possibilities does Malaysia's current strategic position actually open up for your future plans?